What is up, all you real estate loving individuals? This is episode number 31 of the Real Estate Take Podcast, and I'm your host, Wendell Butler. It's your go-to podcast for tons of information regarding the current real estate market, where we get various real estate professionals' current take on different areas of real estate. Today's guest, we have Shawn Moore. Shawn Moore is the host of the Vacation Rental Revolution podcast, founder and CEO of Vodyssey, the nation's largest group of short-term rental investors, and he is an international best-selling author, a husband, father, and much more. Whether you're looking to get into the short-term rental industry or wanting to learn how to boost occupancy and revenue with your current short-term rental strategies, he is the go-to guy. So let's invite Shawn on in here. Shawn, how you doing today?
Wendell, I appreciate you having me. Thanks for the invite.
No, absolutely. And I love that your kind of niche or specialty is short-term rentals in that space, because we haven't really had anybody on that has really dove into that. And there's a ton of people that are interested in it. They just don't really know where to start because they just look at Airbnb and stuff and they're like, that's cool, I would love to do it. But they have no idea what to do. And some people don't know what to do, get into it, and just don't do really good at all and then get out. So it'll be awesome to talk about it a lot and just learn the ins and outs and kind of your opinion on it. But just to get started, I just want the audience to learn more about you. So I usually start off by just asking, like, who are you? What got you into real estate? What's your backstory? And just kind of just be open book and let us know about you a little bit.
Yeah. So I'll dial it back a ways, because I got into real estate 25 years ago is what really my introduction into real estate investing was. And I've been around a lot of different asset classes. Now I hang around the short-term rental asset class really strictly. But going back, I got into it early on when I was in my 20s, and that tells you how old I am now. But that's all that's ever paid my bills for 25 years. And so it became not just a hobby or a side hustle. It became really what my job was for a long time. And I started in the fix and flip game, and I would buy houses. And for 6 years, I would buy them and buy ugly houses and rehab them and resell them. And we did that for a long time. That's what got us into the game. And I remember going to a short-term rental. I went to a real estate investing club. Back then, you had the real estate investing club. You still do today. And I would go to the meetups, and I was there more to show off than learn anything. Back in my 20s, I was cocky, thinking I owned the world because I had figured out a couple ways to flip houses before it was really popular. And an old guy named George put his arm around me one time. He's getting tired of my cocky attitude, I think, and my ego. And he said, "Shawn, you're not a real estate investor. Quit referring to yourself as a real estate investor. You have a job buying houses, fixing them up, and selling. And investors have assets that create passive income and pay them. And so until you start investing into assets for the long term and create passive income, you need to quit referring to yourself as an investor." And at the time, I was really mad at George. I was like, man, this guy doesn't know what he's talking about. Whatever, I'm making really good money doing my fix and flip business, and I am an investor in my eyes, right? But I went home and talked to my wife, and I said, man, maybe this guy maybe there is something. If I stop buying houses and I stop fixing them up, I'm stop making any money. I don't really have anything created passively. And so that got us introduced to long-term assets. And we got into the long-term rental game and started buying single-family long-term rentals. And at the time, if you could fog a mirror, you could get a mortgage. It was what led us to the big crash in 08 and 9. But this was in the early 2000s. And I was like 2003, 4, we ended up buying 27 properties, which was about 52 units at the time. Some of them were single-family homes. Most of them were duplexes, small multifamily. The largest I had was a fourplex. And so we started getting into the long-term game and started to realize, okay, this passive income's kind of nice. I mean, it wasn't anything that really excited me. I remember at the time, we thought that when I had all my properties, we were making about $3,000 a month passively. And I would do a fix and flip and I'd make $30,000 to $40,000. So I'm like, I would rather just keep doing my fix and flip. I don't know that George really had this figured out. And so I ended up selling all. I just got rid of all my long-term rentals and thought, I'm just going to take the capital. I'm going to start doing bigger deals, development deals, all that kind of stuff. And then the market crashed on us right in the middle of this. I sold them all in 2005 and 2006. And then a couple of years later, the market crashed. I looked like a genius because we cashed out on all these properties right before, right? And and it had nothing to do with me being a genius. It just had me to do with me being, I didn't like owning them. Looking back at my age now, I'm like, man, if I would have kept those properties and they would have been paid off, they would have been creating a significant cash flow. This time they would, that portfolio would be bringing me in probably $50,000 to $60,000, not $3,000 a month, because everything would have been paid off. Rents have gone up significantly over 20 years and they were in good areas. And so I look back and it was probably the biggest mistake that I ever made in my career was getting rid of all those assets that somebody else was paying. And fast forward a little bit, we had some kids. I have twins. I had two kids at this end. So boy and girl, we had twins. And I started thinking, what do I really like about real estate? I was in the development game at that stage, sold all of our long-term rentals, started getting into a little bit interested in some multifamily stuff. And during the crash, when everything was really going down, I bought a vacation home. And at the time I bought the vacation home, this was before Airbnb and any Vrbo was even around. We would rent it on the weekends especially like during that slide when everything else was going down. And I needed to make a little bit of extra money. So I put this on the local classifieds and Craigslist, and we were making money on renting this out on the weekends. And it kind of opened my eyes back then to, man, maybe there's something to this short-term side of life, and way before it was popular, right? And because of that exposure to that and getting exposed to that back in 2011 and 12, we really started to look at it and say, man, maybe there is something to this game, buying these assets and renting them short-term. And so that was our introduction to it. But it was an introduction during a time when it wasn't very popular. Nobody even really knew what they were. Airbnb wasn't around. And two, we saw how they performed in a really horrible time for real estate. And that property was still losing value, right? Every time I felt like every day I turned around, the property was worth less than it was the day before because the values were sliding, but I was making really good money and I was starting to make more and more money even while the value was going down. So I was like, okay, there might be something to this. And fast forward to where we're at today, we dove all into this game back in about 2015 and really started watching this asset class grow up, watching it become the shining star right after COVID, and everybody and their dog was interested in short-term rentals in the real estate game. And it was a lot of people's introduction was that post-COVID era for a couple of years into short-term rentals. And it was really a nice uplift into the game. And it really became a mainstream asset class overnight. But it was interesting because it's a mainstream asset class at this stage. And yet a lot of people are still trying to figure it out. A lot of people were introduced to this asset class at a time when everybody, like it was like having toilet paper during COVID. Anybody with a short-term rental for a couple of years was making money. Didn't matter whether you had good property, knew what you were doing, understood marketing, understood customer experience. None of that mattered. You made money. And so when that's everybody's introduction to a game, fast forward to today, when you actually have to understand the fundamentals of the game, and you hear of people like you just mentioned at the beginning of the show, there's a lot of people who have kind of tried out the short-term rental game. They're like, oh man, this wave went out. And when the wave goes out, like Warren Buffett says, you find out who's swimming naked, right? And there's a lot of people that are realizing that, hey, this has to be treated like a regular business. And that's been a fun thing for us. Not that people are having to necessarily go through the pains of figuring it out as a business, but really for us as educators and being able to help people get into this game, it's nice to see the fundamentals actually matter again. And the things that pull the levers that we pull to have success or not have success, they actually matter. And we're seeing that right now. And a lot of people are starting to realize that in the short-term rental game, but there's so much money being spent by the consumer on short-term rentals. It's understanding, how do I go get my fair share or unfair share? I always tell people how do you get your unfair share of those dollars being spent? And that's been a fun thing for us in the real estate investing game right now.
Yeah. And you touched a lot on a few things, like especially the wave, like coming in and then going out. Like we saw that a lot with, like you mentioned, during the COVID times, because I think everything at once hit where like people were like, oh, real estate investing is the best because COVID, there was trillions of dollars printed. So like prices were going up everywhere and you could buy anything and just like resell it and make money. Yeah. So like there was a ton of fix and flippers coming in. There was a ton of like long-term rental investors. There was like short-term rental investors because you couldn't really lose. And if you lost during COVID, that's very unlucky. I don't know how you really did. But yeah, like once that ended and once the interest rates came back and then normalcy kind of came to the market again, you really realize like who was just kind of throwing darts at the dartboard and who was actually like using the fundamentals. The people that were using the correct fundamentals in all those avenues of investing or businesses continued to do very well. But then probably 90% of people that were in those businesses all of a sudden lost their shirt because nothing started working. Fix and flips and numbers were just totally off. Like they were using just terrible ARVs, and ARV is one of the most important numbers for fix and flipping, and that's where people getting it wrong. And all that occurred, and then people realized like, dang, investing's hard. It is hard, and the market's hard, but like this is how it usually is. COVID was like kind of a mirage. You know what I mean? And I think too many people saw that, got into it, and was like, wow, this is awesome, and then just got kicked in the butt at the end of it because they're like, nah, this is nothing like it should be.
Right.
So back to like short-term rentals too, it's like that was a huge influx within COVID, right? So like you had Airbnb kind of being introduced before COVID. I forget when they kind of came out, but like they blew up so fast.
Right.
Everybody hopped on that train, and then hotels in that industry were just blindsided by it. So then they had to start changing the whole business plan to be able to start competing with Airbnb. You could basically buy any house and just Airbnb it. There was no laws in place, like no city, towns, so they really even knew what it was. But now we're looking looking at hotels have figured it out. Most hotels are actually cheaper than Airbnb. So like if you have an Airbnb in the city and stuff, a lot of people are saying, why would I even get an Airbnb? Just get a hotel. And then also cities and towns are kind of being like, yeah, no Airbnbs in this area. Like they're making like laws against it to help, which I guess is help like first time home buyers and stuff, which is fine. But there's a lot of like scrutiny on short-term rentals right now. But in my eyes, and you can talk about this as well, if you really find a niche within the niche, so a niche within short-term rentals to have like a property that's actually considered like a vacation rental, right? It's like an actual experience, right? You're providing an experience. That's where you set up your business the correct way, and that's where you can kill it, because you're giving people something that's different from what they normally have or have available. And that's where you can get like the premium of rents and really give people a great time and give basically a great service to them. So touch a little bit on that and how the market shifting really, one, changed other investors' kind of game plan. Did it change your game plan at all? Or have you been doing it like how you should be doing it since the get-go? Break that down a little bit about the whole change. It was a huge shift in like people talk about nowadays like Airbnb bubbles popping, etc. So like dive into that a little bit, I guess.
Yeah,
I'd
love
very
to.
open-ended question, but
I'll take it back. And one, the fundamentals actually matter again. Right. And so I wrote a book called What the Hell is a Lifestyle Asset? I started writing that book back in 2017. We released it at the end of 2019, 2020, before the COVID boom. Right. And we talked about the fundamentals. You have to remember, I came from a background of being a developer. And as a developer, when I go try to develop a piece of property, I have to fall within the zoning and the planning and the density requirements and everything else. I can't just go put a 7-Eleven on any corner. I can't build an apartment unit anywhere I want to. I have to have the rules and regulations are in place in a lot of these municipalities for certain asset classes, for certain densities, for certain commercial buildings and zones and everything else, right? There were never those short-term rentals were never considered a mainstream asset class. So a lot of municipalities really never addressed them. They didn't have rules in place. It was like the Wild West. It was this brand new asset class. But I also came from a world where zoning mattered, density mattered, getting the right approvals mattered. And so we had always had, as part of our underwriting, are we able to get licensing and permitting to operate these? And for a while, it was hard to find areas that actually would address it. And a lot of vacation areas addressed it before other areas because they were used to, like short-term rentals still were around for a little while, right? Like I was telling you, I started doing it on Craigslist and KSL which is a local classified in 2006 and 7. Well, Airbnb started in 2007. Verbo hit the scenes a little bit sooner. And they started from 2012 to 15 to 17. Vacation homes were a thing in vacation destinations. And so a lot of those vacation destinations started to address those rules and regulations sooner than like the urban centers and some of those city areas that were really dominated mostly in the hospitality world by the hotels and the hotel chains. And they didn't really address it until the COVID. Well, for us as investors, that was always part of our underwriting. I don't want to pay a lot of money for an asset class that I can't get the licenses and permits to operate. And so that was something we always have looked for. And now it's imperative to look for that, right? It's imperative to be able to go do that. The other thing is, like you say, the Airbnb bust. Well, the bust is happening for a lot of people, and it's really true. A lot of the headlines you read are, one, a lot of them are kind of clickbaity. People love bad news, right? Yeah. But they're true. Most properties on the market, if you buy them today and the revenue that they generate, most of them would lose money. 80% of the properties that we underwrite would lose money as an Airbnb. And so, or a short-term rental. I say an Airbnb, but short-term rental, period. And the reason for that is because they don't understand underwriting. They don't understand the fundamentals. Everybody started underwriting, like you mentioned, even like the fix and flippers. And a lot of people got really lazy during that COVID boom. It didn't matter. Like people were buying properties, overpaying for properties that we would never have bought in my fix and flip days, and then buying them, closing on them, putting them back on the market, knowing that they were going to get 30 offers and it was just going to sell for over asking, right? And they were going to make this money. They were making bad decisions across the board in real estate for a couple of years. Short-term rentals, this asset class happened to explode onto the scenes back then, and that's what people learned was normal. Everybody's like, well, listen, you're going to make 3 or 4 times what you're going to make as a long-term rental. And it was true for a little while, and they were forgetting about the fundamentals. If you go take 10 fitness, like personal trainers, right? And they say, hey, listen, 90% of their workout plan and their getting somebody in shape plan is going to revolve around exercise, diet, and sleep, the fundamentals of health, right? What you eat, what you put in your your mouth, how much you're exercising, how many calories you're burning, and what you're doing to build muscle, and then how much rest you're getting, period. They're going to revolve around that because those fundamentals have been around since the beginning of time, right? You take 10 short-term rental investors, most of them that learned during a time that a lot of these things didn't matter, their fundamentals are going to be way different, right? Yeah. The fact of the matter, our game still, it revolves around very simple fundamentals. You have to buy the right property in the right area. You have to set up a unique experience for a target audience, and you have to understand how to market it. Those three things have to be dialed in for any successful short-term rental investor. The issue is the fundamentals have always been there, but they haven't been really necessary up until very short, like a very short period of time for a lot of investors that just barely got into this game, right? The fundamentals of fix and flip. I have to find a property under value or one that I can add value to by forcing that appreciation, right? And understanding how much that's going to cost me, understanding the after repaired value. What am I going to sell it for? Really the fundamentals of underwriting and being able to resell it. We have fundamentals in short-term rental game that a lot of people just haven't dialed in and don't understand because they haven't been taught the fundamentals, or they haven't realized that those fundamentals are important. They're starting to realize that though. And it's a good thing for the market. It's a good thing that a lot of these areas are deciding where and how they want short-term rentals to fit into their communities. The regulations are not a bad thing, right? It caught a lot of people off guard, and a lot of people are like, holy crap, I just bought a property and I can't do it. Well, that's because you didn't understand the fundamentals. Why would you ever buy an asset that you're not able to get licensing and permitting to operate? And like for us, we say that seems like a bad mistake on the front end. For a lot of people, they just didn't even know to look at that. And so the asset matures as the asset grows up. And what we're finding now, and in any market, any mature market, 20% of the market makes 80% of the money. And we're seeing that in short-term rentals now. Like the top of the market makes most of the money, just like any other market.
Yeah. And like you can also relate that to like with short-term rentals, right? You can relate it to even like real estate agents. Like you saw how many real estate agents came in during COVID because you could just like post a house and just take like a picture with your thumb in the picture of it. And it would still sell overpriced cash, no inspection, just sell it. But then now you're seeing it takes a lot to sell a property. Now you have to actually market it. You have to actually negotiate. You have to actually explain stuff. You have to actually show a lot of information regarding the properties, have good photos. And like you said, it's dwindling out a lot of agents, which is probably doing the same thing with short-term rental investors as well. And same with long-term rental investors. Like even long-term, you have to have a better product today because life is so expensive and the economy is just really squeezing people's dollars that they're going to try to pick the best one possible that they can find because they have to really make a firm decision instead of just going anywhere, you know, and going into like whatever unit possible. So I think it's a good thing because it's washing out a lot of the bad investors, which the good investors and the good people with good fundamentals, like you were saying, are going to just reap the rewards and be the very, very good. And in the future, when real estate goes up and down, and there's going to be a point again where it starts just getting on fire, and those people that do the fundamentals and continue doing it are going to absolutely kill it. And you just have to learn the fundamentals, stick by it, always fundamentals, no matter what market it is, and you'll be fine. Like you explained, people were buying, and I tell people this all the time, like they'll buy a single family like in the city and just say, I want to Airbnb it because it looks really good for numbers. And I'm like, well, did you underwrite it for long-term rental? Did you underwrite for mid-term rental? Did you make sure that there's separate kind of ways that it can make money in case the short-term rental doesn't work? Or did you make sure that you can actually do a short-term rental? Is there lease terms? Like, do you have to have someone there at least 30 days or more per lease? Like, you have to have a permit for it. And a lot of people don't even look at that. They just buy it and they're like, oh, it's going to be great. And then they put it up without even trying and it doesn't do good at all. And then they're like, shit, well, let's try to put a long-term renter in it. And then they see the rents for long-term and it doesn't even work. It's not even like half the mortgage. So it's very important, like you said, to make sure that you hit those fundamentals and underwrite every deal the same. And yeah, I mean, with the rentals that you look at for short-term rentals, you look at it so much from like a vacation kind of experience mindset and kind of product that you don't even have to look at if it could long-term rent or if it can mid-term rent, because you just know that like it's going to be so strong short-term rental wise, and you do just so much due diligence that it's almost like confirming that it's going to work for you to buy it. Like, is that how you kind of structure it? Do you ever look at it like with backup plans or anything like that in case anything happens? Or do you just have so much due diligence up front the correct way that it works? Like,
I think it's a great question. And because I hear a lot of times people will say, hey, listen, do you have a plan B with this property? Do you have a backup plan? And the fact of the matter is most properties don't work both ways. The fact that that's the reality sounds really good to have a backup plan and long-term rent it if you can, or mid-term rent it if you can. There's usually a highest and best use for every property, right? Yeah. And for short-term rentals, that's absolutely true as well. Like going back to the early days, if I bought a strip mall, my backup plan can't be a long-term residential rental, right? It's a strip mall, right? For example. And you have to kind of look at short-term rentals the same way. If we could long-term rent short-term rentals, a lot of these areas, they're a lot of times more expensive areas, higher priced areas. They don't pencil out as long-term rentals. If they did, we would do it. It's easier. It's less work, right? We would just turn them into long-term rentals. I would love to have a portfolio of these really nice houses that I could just put a long-term renter in there, pay the bills, make the money that we make, and make it work. The matter is, it just doesn't. They're higher quality areas. The ones that we buy are not going to have a plan B as a long-term rental, midterm rental, sometimes midterm rental, but we're going to underwrite it. And this is where people get into a lot of trouble, is they don't understand how to underwrite it. There are a lot of moving parts and there are a lot of variables in the revenue that you can make with a short-term rental. A long-term rental, if I have a 3-bed, 2-bath in a specific area, it's not that difficult to underwrite because I can go on and I can find out what 3-bed, 2-baths rent for on the long-term side. I'm going to have a very narrow revenue range. Short-term rentals are the exact opposite. You're going to have a really wide revenue range from top to bottom on properties are performing, what they're doing. And I have to be able to really sharpen my pencil, understand where I'm going to fit in the revenue in that market, why I'm going to be able to get top dollar or where I'm going to be in the middle of the market or the bottom of the market. I have to understand proximity. I have to understand experience, everything else. And so one, it's understanding what we're going to do on the back end so that we can underwrite the front end correctly, because most of the time there isn't a plan B. Most of the time they're not going to pencil out as a plan B. And so I don't have one property that I own in my portfolio that would pencil out as a long-term rental. And so if I don't make it work as a short-term rental and I don't understand the numbers and I don't understand how to really diligently underwrite on the front end, I'm going to be in trouble on the back end. And so for us, it's really dialing that in. And that's very difficult. It's not nearly, to me, it's the hardest asset class to underwrite accurately than any other asset I've ever been involved in real estate.
Yeah, because I feel like you have to look at so many different situations because there's vacancy factors, there's seasonal, like in the seasons you make more than others. There's certain weekends that you make more than others, like holiday weekends. You have to like really look into and do your due diligence on it, underwrite it correctly. But at the same time, yes, it's very difficult to underwrite, but it's also so many different ways you can make a lot more money. Because you can hit on those things. You can see different, like for example, you can have a short-term rental in a city that has certain concerts or regular festivals or things like that. Or like, I don't know, the PJ Tour comes through, right? Something like that. And you can make a ton of money during those times. But like you said, you have to underwrite it with a lot of scrutiny because you have such a wide range. And if you're banking on just that week, something goes wrong, then that could really put you in trouble. So when you underwrite for short-term rentals, do you do kind of like a absolute worst case scenario, and then a base case, and then a best case, and then you kind of look at it that way and then decide if it's good to move forward? Because that's kind of like, I do that with all my investments, long-term, short-term, fix and flips. I do worst, base, and best case. So I'm like, best case, amazing. If we hit that, I'm super happy. Base case, that's where I want it to land. And like, if we hit that, I'm still super happy. And then worst case, we still make money, but like, it almost feels like we wasted a lot of time and energy on it, but we didn't lose money. That's kind of like how I look at it. Do you do it kind of the same way with short-term rentals after looking at all the different aspects of it and different areas where you can make different revenue and money, et cetera? And do you have like certain left and right limits that like, if it goes over the left limit or the right limit, you're just like, no, like absolutely not? Can you touch on that a little bit?
Yeah, absolutely. And I think any investor should have, your good, better, best scenario, right? It's like, okay, here's where we're at. If we get here, this is our target. And then if we really do awesome, we're going to just kill it. Right. And so you should always, I think every investor should have that. We do that on the short-term rental side. We do that on all of our investments. And you have to be realistic about where that's going to land. And that's where it becomes hard because like, I know that I'm going to operate at the top of any market we go in. And that seems really arrogant, but we've been doing this a long time. It's very predictable about where we're going to hit in a market. And so
we also have just a lot of data, right? Because you've done it so long. So you like know exactly where you're going to land based on data, KPIs, et cetera. And then you also have systems in place, which we can touch on that later, but a lot of people don't want to get into short-term rental because it's more work, which it is in the beginning. Once you build the systems, it's the same thing as any other like investment because it's just
it's rinse and repeat.
But yeah, keep going. Sorry, I cut you off.
Yeah, no, you're exactly right. Like the thing that I like I know, like I have a property that now, and I know the numbers of my neighbor and I are friends and both really nice properties. His property is probably a nicer property than me. We're on the same lake. The properties were on the same lake, same experience for the guests as far as proximity to the national parks and everything else. This property was up Yellowstone National Park. It's on a lake called Henry's Lake. And we make double the money nightly and annually than our neighbor makes. And it's like, okay, why do we make double the money? Our guests know they can rent my neighbor's property for half price, right? They know that. But what we do is a better job of the experience. And this is where any short-term rental investor gets in. This is a hard kind of disconnect for real estate investors, is understanding you're not in the real estate business. You're actually in the hospitality business. You're in the experience business. And so you're buying a portfolio of real estate assets to build your wealth, build your net worth, build that long-term, like having these assets that just create some massive wealth, which is a real estate asset. But the business you're actually in is the experience business. And so really understanding that and being able to buy into that and dive all into that allows you to maximize the real estate asset you have. Your guests don't care that much about the real estate asset. They care about what kind of an experience are they having. The reason we made double the money that our neighbor made up in the property up by Yellowstone National Park is because I created an experience for fly fishermen. They just had a beautiful property by Yellowstone National Park on the lake. The fishermen could use it or not use it. They just kind of were everything to everybody. Maybe families come and use it. It's just a beautiful $1 million cabin, right? And we had a really nice cabin, not as nice as theirs, but we made double the money because I created this crazy experience for fly fishermen. Everything revolved around them. I had everything they needed when they came. I had a box of hand-tied flies. I had maps of the area. We had guide services set up. We had all these things done for them so that when they came to that property, it was an amazing experience for fishermen. Very small group of actual visitors, because the majority of the visitors up there are going to Yellowstone. Their families going to Yellowstone, enjoying the outdoors, right? But we narrowed down a niche, understood we're in the experience business. If we create an experience for a niche group of people, they're willing to pay us more. Consumers will pay more for a more personalized experience. And so understanding that, and this is the difference between success and failure in short-term rental game, is buying into the fact that you're in the experience business and being able to provide and articulate an amazing experience to the consumer so that they gives them a reason to pay double the nightly rate that my neighbor's charging. And when we do a good job of that and understand marketing, it's why I love short-term rentals, because it allows me to get involved in the marketing side of it. I enjoy marketing. I enjoy like being able to articulate that. I hate managing my properties. I don't manage any of my own properties. I don't communicate with the guests. What I do is I put together really good marketing to articulate what we have to offer, and we make sure that we provide an amazing experience through our management. I just set the experience up. I let the managers deliver it all. And to your point, it's a lot more work on the front end than buying a long-term rental or doing pretty much any other asset class, because I have to create all this. I have to furnish these properties. I have to get the custom artwork. I have to get all these things in place. But once they're in place and somebody else is delivering it, it's very turnkey. I look at my P&Ls at the end of every month on the properties, and I look at the calendar when we want to go use the properties. But on the front end, it's way more time intensive.
Yeah. And like the most important thing is experience. And you hit on that a lot. I mean, society today is, with social media, with all the technology we have going on, you have to grab people with something, right?
Mm-hmm.
And giving an amazing experience is what's going to make them talk about your property. It's what's going to make them like your property. It's what's going to make them tell others about your property. And the cool thing about short-term rentals too is if you have such a good experience, they'll market your property for you as well. 100%. So like you're marketing your property, you have them go and you put out like little like pamphlets and stuff like, oh, make sure you tag our Instagram when you post. It's very, very helpful, blah, blah, blah. And then there's probably some people that go there that take amazing content and then they just and give it to you. And then people end up coming, and then like it's crazy how much marketing can and word of mouth and stuff can compound to the point that you have one person go there that might have like a ton of followers, and then they post it, and then all of a sudden you have like bookings on bookings on bookings on bookings. And it's really cool. And that's what's cool about short-term rentals. But in the beginning, it's probably a lot more work to get it going, to fine tune everything. But like you said, once you figure out what you like doing the best with the property and you can build a system around it, like for you, it's the marketing aspect. You can really fine tune that because you're really good at that. And then the managing portion, you can always hire that out and build a system so then you can continue building a business that way. And that's, I think, look at short-term rentals and they don't understand that it's a business and it's hospitality. And you can build your business. You can build any business the way that you want it to build. You do not have to do it the way someone else does it. You do not have to do it the way another person does it. You can do it any way that you want. If you want to build it to the point that you do nothing and it just runs, you can do that if you want to. It's going to take a little bit to figure out the systems and stuff, but that's what you got to think about when you're going into short-term rentals. Because if you end up doing everything the whole time yourself, I think you will burn out and it will cap you to a point that you're like, Jesus, like I'm handling talking to the tenants, I'm handling bookings, I'm handling cleanings, I'm handling marketing. You can only do so much yourself. And then you're going to end up looking at your P&L after and be like, Jesus, was that even worth it? But the way that you have it set up, and I'm sure the way that you coach and mentor people to do it. It's to basically figure out your strongest where your time is best well spent in your business, and then you build up your systems around that within your short-term rental space to give the best experience, give the best marketing, and find the best deals, basically. And yeah, if you want to touch about basically, sorry, I wanted to rant there because it is really cool. People don't think about it that way. They just look at like, oh, it's so much work and it's hospitality, which I actually think about it that way. I've had that mental block for a while about it, and everybody else does, because they don't understand that you can make your business kind of work for you in different ways. And yeah, so if you just want to touch a bit on like, I don't even know why I went there, but
well, I think it's a great. I think you touched on something maybe indirectly that you didn't know we were touching on. Other than this is something that holds people back. And here's the issue: is the majority of, I don't know any other coach, guru, expert, whatever you want to call somebody out there that teaches this stuff in the short-term rental space, that teaches people how to build a portfolio where they don't manage their own properties. And here's the reason why, Wendell. And I think it's a disservice to a lot of people, because managing a property is a lot of work, and it is a long-term commitment. When you're basically a 24/7 concierge if you're managing your property. Now, you might only have 5 to 10 hours a week per property that you have to work, and people are like, well, I can handle that. The problem with it is you don't get to schedule those 5 or 10 hours. When you're a 24/7 concierge, it's when somebody can't get the door unlocked, or they can't get the fan to work, or the TV to turn on, and they can't figure that out. And it's not the hours you want to work typically, right? It's usually not unclogging toilets and everything else that people make fun of with long-term rentals. It's, hey, I can't get the TV working. And so they teach you that it's very easy with the systems to manage these properties. The fact of the matter is, if it was easy, I would do it. Yeah. It's not easy. And I don't want to be a 24/7 concierge. And so I build portfolios. I teach people to build portfolios who are not looking for a side hustle. They're not looking for a second job. But the reason why people don't teach you to do that is because when you underwrite deals and you put on the expense column, management of short-term rentals is going to be 25 to 30% of your gross revenue. It's a huge expense. Right? And so if I'm trying to convince you to invest in short-term rentals, that pro forma looks a hell of a lot better if I remove a 25% expense off the gross revenue. And so people, in my opinion, get misled a little bit saying, hey, listen, you just manage it yourself. It's so easy. And this game looks like it's so profitable. The fact of the matter is, the amount of money that we spend on management is a fraction of the amount of money that I make by not managing my properties. Right? And by actually setting it up as a business. And so I'm happy to pay management fees, and I'm happy to pay that, but the pro forma looks a lot worse, right? When you have a 30% of your gross revenue right off the top to a management partners, like, I get why people leave it off. I think it's a disservice to a would-be investor that is getting into a game that they don't quite understand. And the fact of the matter is, you can build these portfolios, have somebody else manage it, still make a lot of money doing it. And you just have to be more diligent on the front end of buying the right properties that can support that type of management, right? Which you should anyways. There's a cost to management. It's your time. You're going to have systems costs if you're managing your own properties, right? You're going to have, no matter what, you're probably having 10% of your gross revenue go to your property management systems and your pricing tools and all that stuff anyways. So is your time worth that extra paying, that extra 20% of your gross revenue? Most investors, most busy professionals that have the ability to go buy second homes, that's not worth your time to do that. And a lot of people just make it sound like it's so easy. Well, if it was that easy, I can tell you, we work with 3,000 investors. We have a portfolio of almost 3,000 homes across the US, and 95% of them are professionally managed, making money. And there's a reason that we have professional managers doing our own properties, is because it's more profitable to do the things that we do so that we can go buy more properties.
Exactly. It's the difference between scaling, and it's the difference between working in your business and on your business, right? People get into real estate most of the time, whatever niche it is, to create financial freedom or freedom from like their W-2 life and basically live life on their own terms, right? If you build your business to the point that you're doing everything in it and you're managing it and you're doing every single aspect of it, that's not the freedom that you're looking for. It might be, I don't know. If you love it, cool. And you're fine with like 2 or 3 properties and you're just managing it and you love it, awesome. But if you're looking at it as like, I want to build a business, I want to build a portfolio that pays me as passively as possible, that I can go travel, do whatever I want, you have to pay for services and systems to be able to create that. And yes, it's going to take a little bit to get more money or revenue coming in or net profit, because you're building a system and paying other people to run your business or help run your business. But that's how you scale. And that's how you get to 3,000 houses like you do, right? Because I guarantee you, if you were managing everything yourself, you would probably get capped at like 10. You'd be be like, screw this, I
Right.
can't do anymore.
Right.
Yeah.
That's why I tell people, don't manage a property to save money. Manage a property because you love hospitality. Manage a property because you love that part of the business, and that fits your personality and it's what you enjoy doing. Because to save money is usually not very productive. And I think that it is a little misleading on the front end, where a lot of people have gotten into this game saying, oh, so easy. I know a lot of people who manage their own properties, and I know what time it takes. And it's not a 40-hour-a-week job or to manage a couple properties. It's 5 to 10 hours a week per property, but it's at hours that you might not want to be making calls and communicating with your guests and trying to get them to unlock the doors and things like that. It's never on a Saturday afternoon when you blocked 5 hours outside of your regular job, right?
Yeah, it's always just in the worst times. And then, you're only working 5 to 10 hours, but those hours are it's a big burden.
Yes.
That'll mentally drain you, because you're like, then you start hating it. Yeah. And that's when it ends up goes the opposite direction. Instead of being more positive and optimistic about your business, it starts getting more pessimistic. That mindset really kills everything in business. I did want to touch on one more thing, because a big factor of short-term rentals is getting proper lending. And I just wanted you to talk about how you set up lending and loans, or if you use them, or if you use private money, what creative ways and strategies do you use to purchase these properties? Because there are a lot of lenders that are starting to lend on Airbnbs and stuff like that, but they usually want a lot of history. They want to make sure you've done it for like 2 years. They want like a lot of risk adverse data for them. But that is also another barrier that people look into, because they're like, how am I going to get a loan on this? Because nobody ever wants to lend to short-term rentals. That's what they say in their mind. So I just wanted to touch on that and kind of maybe take down some barriers for some people that this might be holding them back to look into short-term rentals.
Right. Yeah. Well, because short-term rentals are becoming a mainstream asset class, and because it's a fairly new mainstream asset class, you have a lot of lenders coming up with new products all the time. If you looked 6 months ago and there wasn't a good product, the chances are there's a lot of different products available. And so the landscape is constantly changing, especially on the investment side, the DSCR side, which stands for debt service coverage ratio loans. And those are loans where very similar to commercial property loans when you buy a multifamily unit, where the property itself actually qualifies and you don't have to qualify as the investor, and you don't have to have a lot of history. And in the past, they were like, you have to be a short-term rental investor for X amount of years, like you mentioned. Those loan programs and the products available now are getting way more favorable for the new investors, especially, and being able to go and get these properties qualified. Usually you're going to pay or put 20% down on most of them. Some of them are 15% down loans, but most of them are going to be in that 20% down range. They're going to be about a point to a point and a half higher interest rate than a regular traditional type financing loan, but they are a really good option for a lot of investors. And especially if you're an investor that's maybe self-employed, or you don't have like a full doc type of a loan, if you can get a full doc type of a loan, short-term rentals also have available second home loans, or you can rent out. In fact, Fannie and Freddie type second home loans allow you to they're fine with short-term rental investors buying them and using those loans. They're full doc. You have to have good credit, good income history. But if you have that, they're very favorable terms. It's like buying a primary resident type of a term. They're not even investment type terms. They're 10% down, rates that are similar to primary resident homes. So they've got really good terms and rates, but you have to have the income to do it and the credit history to do it, right? And so if you don't have that, or you use a couple of those, the next step are those DSCR type loans. And there's a lot more available than people probably realize, especially if you looked in the past, and more coming on, less down, better terms, being able to take the income history of a property or the income potential of a property, which is huge. And so usually their underwriting is actually less stringent than we use when we buy properties. And so if we have a property that underwrites for us, it's almost guaranteed to underwrite for the DSCR lenders. And I would say keep always looking if you're staying out of the game because you didn't feel like financing was available, because every day we see more products come online. DSCR loans are very different across the board as well. And so what they are typically is portfolio loans for a lot of lenders. And so what that means is they're not going and just selling them on the open market. So they are all kind of the same terms. If you go look at a second home loan, they're all going to be very similar terms, conditions, everything else. A DSCR loan from one lender to the next is going to have very different criteria, very different terms. And so it is a little bit of a numbers game as well. Private money doesn't work as well for long-term assets because private money typically wants to turn their money more often. So that works for fix and flippers, bridge loans, developers. Those types of things are really good for some of the private lenders, unless you have a private lender that wants to be in something long-term. They're not as often that we use private lenders unless we are going to do like a Burnaby method type of a thing where we're going to actually actually rehab it and then pull and put permanent financing on it. And so I always tell people, I hear people online always talking about, oh yeah, you just get a private lender and you do this and that there. That's not the reality for a lot of short-term rental investors.
Yeah, that's awesome. That's awesome. Yeah, because I was a lender for about 5 to 6 years, and I went from conventional into hard money and private money and stuff like that. And when I was in the game, it was very hard to find short-term rental, but they were coming on board as I was there. I think it was about like a year or two ago. I started seeing them come online a lot more, which was exciting because I always had investors coming with like Airbnbs, and I'm like, I don't really have anything for you. He needs to pencil out with long term, and I'm like, it's not going to. So
right. It's not gonna, yeah, exactly. Like we talked about earlier. You know, the other thing that's really something that we're using right now a lot because the environment is conducive to it is trying to get the seller financing. There's a lot of people, especially in the short-term rental game, that dove into this game right after COVID. They bought really nice assets, really nice properties. They're furnished beautifully, and they're not making money, and they don't know why, right? They're not dialing in the experience, and they need to get rid of them. Well, they're not their primary homes. They're second homes, and they're like, listen, I can't have this weight around my shoulder all the time, but I don't necessarily need all the cash out to go buy another home. And so we're actually able to negotiate a lot of seller financing subject to lease options, a lot of these markets right now on really nice properties and with really good terms. And so that's something that we're seeing a lot in our specific asset class. I know that that's always available. When I was in early in my career, I bought a lot of properties with subject to and lease options. And so it's always out there, but I'm seeing in the short-term rental game specifically, there's a lot of willing sellers to have those conversations.
Oh yeah, definitely. I see them pop up a lot in like water, for example. But the biggest thing in Florida, I feel like, is the insurance change is really killing everything. Huge. So like, be careful. Like listeners, be careful of like those coastal type regions because insurance is going out of hand and out of whack. So be sure that when you underwrite, definitely look at insurance. Insurance is a huge portion of underwriting, and people sometimes forget about it.
It's massive, and it's a really good point that a lot of people don't think about. And a lot of those coastal areas are vacation destinations, and even owners that own right now. I mean, I've got owners that bought in Florida and own, and their insurance has doubled or tripled, and they had a cash flowing property that is negative cash flow now because the insurance goes up and adjusted. And so that's a big wild card. Like we underwrite a lot of properties in those areas. I personally don't buy in those areas because I don't like those types of wild cards. I don't like those types of wild cards and having those variables in my portfolio. And so we had a home in Destin, we had a home in Florida, and we got rid of them both about a year and a half ago, just because of that reason. I don't like the wild card of the insurance premiums going up like they are. And it's a big deal.
Yeah, me neither. Everybody hates insurance, and there's a reason.
Yeah,
because
there's a reason.
And there's nothing you can do. There's literally nothing you can do.
No,
it's insane.
exactly.
So let's start wrapping up here because I know you're a busy guy and we're heading into about an hour. But I do like to end with 3 questions just to kind of end the podcast. So first one is, it's very broad, but you can cater this however way that you want. I like to just always ask, like, what's your number one piece of advice to like a new investor that wants to get started in real estate investing? And let's say particularly for short-term rentals, like what is the number one piece of advice that you usually give right off the bat?
I say invest in your education, invest in yourself. It doesn't mean you have to go hire an expensive coach or anything. I'm saying just dive in and really understand the game. The amount of information we have in front of us, the amount of people willing to help you understand the game you're walking into. Every asset class has pros and cons. Every asset class has good parts of it, bad parts of it. You need to really get educated on the asset class you're interested in, what it takes to succeed, what it's going to take to get into it, what it's going to take to have any staying power in the asset class, right? There's some asset classes like short-term rentals, particularly, that you're not going to make a lot of money probably your first 6 to 9 months in the game, right? There's a lot of costs that are going out the door with not a lot of revenue coming in. And so just one little aspect can be a game changer for you to know or not know. And so I always tell people, if you're new into any sort of investing game, is you need to walk into it with your eyes wide open. And the very first thing you should do is really get educated before, because there's a lot of shoot, fire, aim guys out there like me. I was a shoot, fire, aim guy. And when you do that, you walk into a couple buzzsaws, and those buzzsaws in real estate can be really expensive.
Yeah, if you make a mistake in real estate, it can be hundreds of thousands of dollars sometimes. And you're like, you really set it back.
Don't discount the value of education.
Yeah, I always say when people want to get into real estate, I say find a niche and really learn about that as much as you can, to the point that you start listening to podcasts or a book, you start reading books, and you start hearing the same thing or reading the same thing again and again, because there's only so much that you can read. Exactly. If people start regurgitating the same stuff, that's when you know it's time to just take that action step and go.
100%. That's a great way to kind of judge it, because The thing that you don't want to do is, one, there are no secrets out there. If somebody's telling you there's a secret that they just found out about and they've been investing forever and they have this thing that they just discovered and nobody else knows about it, you got to pay them to get it, run from that person, right?
Yeah.
The fundamentals are the fundamentals. And you will hear the same thing over and over: right property, right location, create an experience for a target audience, understand how to market it. You start hearing the fundamentals. Then you start saying, okay, now I need to learn a little bit more about those fundamentals. And I think you made a great point that I'm going to probably steal and use is, as you're starting to educate yourself, you're going to hear things over and over. And you're going to see that there's certain things that keep coming up. And that's your kind of sign to say, okay, maybe I'm starting to get a pretty good foundation of understanding here.
Exactly, because people get stuck in paralysis analysis and they'll keep reading the same stuff, listening to the same podcast, hearing the same stuff again and again, and they just never make that step. But yeah, once you start hearing the same thing, you're like, oh, I've heard this before. Like, oh, this is this again. That's when to take the leap, because you're never going to be ready, right? You're never going to be 100% ready.
Timing's not going to be perfect. You're never going to be ready. Market's never going to be perfect. The perfect property is never going to present itself. And if you just sit there, you're never going to do anything.
Yeah, and you learn the most from doing. So like, learn as much as you can to the point that you can make the best educated judgments and decisions possible. And then jump in with those fundamentals. And that's when you really start the in-depth learning. And then that first deal, I always say that first deal, if you break even on it, that's a huge freaking win, because you just learned a college worth of running the property or doing whatever investing you were doing, and you didn't lose any money.
Yeah.
Awesome. That's a home run, right? Yeah. If you make money, that's amazing. And if you lose money, it is what it is. Just learn from it and fix the mistakes and try again. Keep going. All right, on to the next one, which kind of piggybacks off of what we kind of spoke about, but education. So like, what is your favorite business investing or real estate book that you would recommend to someone to read that really set you with the right mindset into real estate, or even one that you've currently or recently read that really changed your perspective at all?
Yeah, there's a lot of really good tactical books out there, depending on what you're trying to learn in a very specific asset class. For me, it was more of a mindset book. I always recommend Winning by Tim Grover. He wrote two books. It's called Relentless and then Winning, the second. And I think those are really good books when you're going to dive into something. And it talks about the things that are hard about winning, the grind that it takes, the commitment it takes. And if it was really easy to become this multimillionaire real estate investor, everybody would do it, right? And considering kind of that mindset of maybe consider, because it's hard is why not everybody does it. But second, maybe because it's hard, the reward might be even better than you think it's going to be by actually going through the process. And so I love those books, Winning and Relentless by Tim Grover.
Love it. Yeah. And people don't always talk about that. Going in business, any type of business you do, entrepreneurship, whatever, it's lonely, right?
Yeah.
And you get into a period that you're winning, but nobody's clapping for you. You're in kind of your own zone because you're different. What is it? Like 1% of people are entrepreneurs, and like of that 1%, like 1% actually make it, something like that. I don't know. There's some weird quote, but basically you're taking a hard path. Entrepreneurship is the hardest path you can take to create a career or a life that you want, but it is the most rewarding path you can possibly do, whatever business you're in. And you just have to keep going. And there is a time called like the lonely period where you start picking up a little bit of momentum, but nobody's there to kind of help you. You can't relate to your friends anymore because you're kind of over there, kind of like what they want to talk about, because you just want to talk about your business and how to do better and how to win. But they want to talk about like, sports, or I don't know, did 9 to 5 or girls. I don't know. You're just focused on that stuff. And it's called the lonely kind of part of your journey. And you just got to push through that. It's super hard. Nobody's clapping for you. You clap for yourself. But once you get through that, you start meeting more people that are like-minded like you, friends, build more friends that are trying to do the same thing as you. Then you start helping each other win. And that's when you really get the momentum and start taking off, because then you just create a whole new life for yourself. And it's very exciting. It's very exciting, but it is hard. It's super hard. You just got to get through that.
Yeah, it's really hard. And you're right. It's lonely at the top and it's lonely on the way up, because everybody's rooting for you when your back's against the wall, when you're down and out, because it's easy. They're saying, hey, listen, we feel bad for you, Shawn. Good. Keep going, keep working hard. But then when you have success, they're kind of mad at you. They're kind of like, hey, listen, we're not here to push you forward, not because they don't want us to succeed. It's because they're kind of disappointed they're not succeeding, right? It almost puts a highlight on them not doing the things that they wanted to do. And so, sometimes it's not just lonely, there's people rooting against you, and you got to be able to battle through them.
Yeah. And it's always ask people about like investing business books, but the mindset books are the most important. You got to build a base foundation for yourself that you personally are the strongest you can be. And that's in like fitness, that's in mental, etc. Because that's going to allow you to get through the problem, the hardness or the difficulty of building a business. So that's probably the most important thing. I love that you brought up like a kind of a self-development type book, because I think those books are the most important. You can read all the real estate investing books that you can. If you have low self-confidence, if you're not resilient or anything like like that, you're going to fail. So last thing, I like to just give you the floor to kind of wrap everything. And this is where you can kind of tell the audience any media handles you have, meetups you run or attend, charity events, business links, where to find, contact you. The floor is yours to explain all that.
One, I know how valuable, everybody's time is, and I always appreciate them spending it with us and listening as long as they've listened, and we added some value. You can find more of me at Vodyssey.com. Just go to VODYSSEY.com. Has all our social media handles. We try to post regular content. My stuff's never going to go viral. We're not for educate, or we're for more education, not entertainment. I'll forewarn you, but we do try to post everything to help people walk into the short-term rental game with their eyes wide open. We do live trainings, events all the time. Don't cost you a dime. We do, like I was just telling you, we were just in your backyard in Charlotte doing a meetup, Charlotte, and speaking at an event there. So we post all that on the website. And so you get copies of our books, our trainings, social, whatever road you want to run down. That's a great place to start. It's got links to our podcast and everything else.
Love that. And I'll put all the information in the bio for everybody listening. You can just easily go click it and check. But thank you so much, Shawn, for coming on. It's always amazing to hear different aspects of investing, and short-term rentals and vacation type investing is something that we haven't really had on here. So it's amazing just to see that you're doing it, killing it in this hard market with a talked about strategy that people say doesn't work anymore, or it's hard to make work. You're killing it and doing it because of fundamentals. And the fact that you came on this and kind of explained all this, it's going to be an eye-opener to a lot of people. So thank you so much for giving us your time and coming on here.
Absolutely, Wendell. I appreciate you having me, my man.
Absolutely. And thank you all for listening.